If you're in the housing market, I'm sure you heard last week this new rule by the Biden administration. It was a mandate pushed through Fannie Mae and Freddie Mac, and it has to do with the pricing of the loans. And let's take a look at what's been written. Biden raises costs for homeowners with good credit to help risky borrowers. That's one headline that came out. This one here, Biden administration to punish those with good credit scores. This one here, homeowners with good credit to pay higher mortgage rates. So what's really going on? Are these just clickbait headlines? What are the facts behind this? I wanted to go in and take a deeper dive. And one of the best articles I've seen is this one here by Mortgage News Daily. If you're in the housing market and you really want to invest and see really what's going on, this is a great resource. I'll put a link in the description. But within this, it gets into the details of it. I highly suggest you go in and read this article. But really, we want to focus in on these two charts right here. And specifically, let's dive into this and let's look at kind of the sweet spot, if you will, for pricing, which would be this 640. See this 640 at 80%. So if you have a 640 credit score, your credit's pretty good. And 80% loan to value means, you're putting a significant down in on the property. And so under the old pricing model, we were looking at a negative 0.75 in the overall pricing, meaning that when your mortgage professional went in and priced that loan, it was a discount over the par interest rate. And I know that gets kind of confusing. But let's jump in and let's look at the new pricing model. This is for purchases. We're going to go 80%. We're going to go 640, 80% right there. So now it is a cost. So we went from a negative 0.75 to a cost of 2.25. The difference in fee payment to you is about $4,500. So that's the difference. Now, why are they doing this? Well, the mission statement of Fannie Mae and Freddie Mac, these are the two government-backed mortgage companies, their mission statements is to make homes affordable for everybody. So under the previous pricing model, people at the lower end of this chart with higher loan to values and lower credit scores, they were getting priced out of the market. But I think a little bit deeper dive into this, you have to include FHA into this, because what I think is happening is that FHA was winning. They were winning more of these borrowers' loans at the lower tier, because FHA is designed for the lower tier of the market, higher LTV, lower credit scores. And when they went in and changed this model around, well, now they're more competitive with FHA. So those are my thoughts on it. At the end of the conversation, I think it is going to make homes more affordable for the lower tier. The upper tier of the market, for the most part, it isn't affected. So if you're at a low loan to value with a super high credit score, there is no change to you. But it is that middle market, as you can see from the graphs, and it is making homes more affordable. Good, bad, and different. They're going after their mission statement. So I hope you find this useful. If you like this information, give me a thumbs up, share it with your friends, and I'll catch you on the next video. Thanks.